Imagine you're watching a basketball game. Your favorite player has just hit 5 three-pointers in a row. They are on fire. The crowd is roaring. The commentator says, "Give him the ball. He can't miss." Now tell me honestly, when they take the next shot, do you think they're more likely to make it or miss it? If you said make it, you just fell victim to one of the most dangerous, most costly traps in all of finance. It's the reason why so many investors buy high and sell low. It's the reason why last year's stock market success is the worst possible predictor for next year's returns. Welcome to MindVist, the channel where we decode the psychology behind your money. I'm Dr. MindVist, and today we are dissecting a cognitive error called recency bias. This bias is simple. Our brain overweights the most recent information and assumes it will continue indefinitely. It's the human tendency to believe that the last chapter of the book is the whole story. Let's go back to our basketball player. The truth is, the probability of him making the next shot is statistically independent of the 5 he just made. It's a classic example of the hot hand fallacy. In the office, this is why a manager gives a better performance review to an employee who had a great last month, even if the previous 11 months were mediocre. The recent event is simply more vivid, more available in our memory. Now, translate that emotional impulse to the stock market. When the market has been on a tear, say 5 years of double-digit returns, what do you hear? You hear pundits proclaiming a new normal. You see friends piling into the same few high-flying stocks. This is recency bias in its most dangerous form. We look at the last year, or the last 5 years, and we extrapolate that straight line into the future. We forget that the market is cyclical, not linear. To truly understand the cost of this bias, let's look at a story many investors have forgotten: the lost decade. In the late 1990s, the dot-com boom was in full swing. Technology stocks were delivering astronomical returns. Investors, blinded by the recent success, poured every last dollar into the growth category, convinced that the internet would only go up. Then, the bubble burst. From March 2000 to October 2002, the Nasdaq fell nearly 78%. But here's the kicker. For the entire decade, from January 2000 to December 2009, the S&P 500 delivered a total return of virtually zero. Zero. Investors who made their decisions based on the recent 5 years of glory were devastated by the next 10 years of stagnation. They bought at the peak of the recency wave and were forced to sell at the trough of despair. Why does our brain do this? It comes down to 2 things: the availability heuristic and cognitive ease. Availability heuristic. Simply put, the most recent events are the easiest to recall. They are the headlines we read, the conversations we have, the charts we see every day. Our brain mistakes the ease of recall for the frequency or probability of the event. Cognitive ease. It's easier for our brain to assume the future will look like the present than to do the hard work of historical analysis, diversification, and rebalancing. Our brain is lazy, and recency bias is its favorite shortcut. So how do we, as rational investors, fight this deeply ingrained human tendency? We use the tools of behavioral finance to build a wall between our emotions and our money. Strategy 1. Embrace the cycle. Look at the market not just over the last year, but over the last 50 years. You will see peaks, troughs, and long periods of sideways movement. The only constant is change. Strategy 2. Automate rebalancing. This is your single most powerful weapon against recency bias. When you rebalance, you are forced to sell a little of what has done well and is now overweight, and buy a little of what has lagged and is now cheap. This forces you to do the one thing your emotional brain hates: sell high and buy low. It's a mechanical, emotionless counterpunch to the bias. Strategy 3. The 10-year test. Before you make any investment decision based on a recent trend, ask yourself, if I look back at this decision in 10 years, will I be glad I ignored the last 12 months of noise? The stock market is not a hot hand. It is a complex, cyclical machine driven by decades of history, not just the last quarter's earnings report. Your goal as an investor is not to predict the next shot, but to own the whole game. Fight the urge to chase the recent winner. Stick to your long-term plan. Be disciplined. Be a MindVist investor. If this video helped you understand the psychological traps of behavioral finance, hit the like button. Subscribe to MindVist for more deep dives into the science of smart investing. And tell me in the comments, what recent market trend are you trying to resist right now?